again, thanks a lot for joining us. It is very, very nice that so many of you actually join our presentation for today. If I start with the first slide here, we would like to give you a bit of a big picture first. If you look at the S&P 500, I'm pretty sure several of you have seen this chart already. You realize that the top 10 concentration of the S&P 500 has reached 32%. What I like, and particularly with this chart, is though that it goes back to the 70s, to the Nifty 50 situation. And you see that we were already here at once at 35%. Interestingly enough, the year 2000 was not as large when it comes down to concentration, because we were in the range of 27 to 30%. Now, here this chart actually tries to explain that whenever you had such a high concentration in few stocks in the S&P 500, it later on needed almost 10 years to digest this kind of concentration, because quite often this high concentration lead as well to valuations that are currently in the 30s and 30s plus for the Magnificent Seven, as we will hear later on from Marcus as well. Now, another interesting way to look at it, this time we actually look at it at MSCI World, which were the largest 10 companies in the specific decades. You see the first decade in the 80s, peak oil. You see the 90s, Japan take over the world. By the way, MSCI Japan at that time had a concentration of 40% within MSCI World. Then you see the year 2000, the TNT bubble. Then China will take over the world, 2010. And this time, 22, only tech can deliver growth. And what's interesting, if you look at how many companies survive from one decade to the next, you can actually see that on average, 1 to 2 companies survive in the group of the top 10. If history says something, then I think at least it's a warning sign here to not just focus on the Magnificent Seven. And that was my short intro. And we still have people on the waiting list. And with that, I would like to pass on to Marcos. Marcos, please.
Thank you, Alex. Thanks a lot for the introduction. Well, good morning, everybody. It's really a pleasure to have you all in the call. So I will just start the presentation following the introduction with where we are in the cycle, that we like to give a kind of picture of where we are. So for us, 2023 has been surprising or strange. We expected a slowdown, even a recession in the US and Europe, and we also expected an improvement in China, and both they neither materialized. So we stay with our base case. We are in a global economic slowdown. This can end in recession or not, nobody knows. As per Warren Buffett, he always says that is not predictable. So we continue to manage our assets with caution. So we have some cash, and we are overweighting the categories 1 and 2 that are more kind of defensive or high quality. So just to give you a point here, if there is a recession and there is panic, which is a normal behavior, we will rebalance the portfolios, reinvesting this cash and overweighting higher risk categories, 3 and 4, that are more cyclical normally. They are high quality, but more cyclical. And this is kind of counterintuitive, but the bigger the correction, the more money we will make. That's for sure. Anyway, the portfolios are built to overcome any slowdown or any recession, so we are not worried about that. And we follow Buffett advice that you can see in the lower of the page, that he always says that we need to embrace uncertainty rather than fear it, and be ready to navigate. So we think we are ready to navigate any slowdown. Slide 6, please. So this is one of the pictures I want to show in terms of where we are in the cycle. Industrial production still negative. You can see the chart. The US is down more or less 1%. I think this is from November. Europe is down 4%. So still, you know, a couple of years of slowing down in terms of industry. And Europe is already well advanced in the cycle, and the US has just entered in negative territory. China is up 5%, but China, as you know very well, is having other issues. So, you know, if I apply normal behavior here, the cycle normally lasts 8 quarters, so 2 years. Europe is probably reaching the end, and the US is still early, so we still have probably 2-3 quarters of a slowdown numbers. So we need to be patient here on the industrial production perspective. Next slide, you can see the inflation. Here we were right, as you recall, we were saying many quarters ago that inflation would normalize, and this has happened. I mean, it's surprising to see that inflation is now 2.5% in Europe. So this is done, nothing to comment here. The only small comment we would make here is that we see some structural issues, basically in labor and energy, maybe food, because food depends a lot on energy also, everything depends on energy. So we think that the new kind of a structural inflation will be a bit higher on the last 10 years, around 2.5-3%. And final comment on macro on slide 8 is on China. You can see in the chart how depressed is the property sector. So this for us is a bit surprising because historically the government has been able to, you know, reactivate the sector after a couple of years. But this downturn is more complicated. The government is, you know, implementing a lot of measures in order to, incentivize the sector. And property is affecting consumers. So this is why the economy in China has been kind of very slowly accelerating this year. So we remain bullish with China with maybe 4 to 5% growth next year, but slowly. We don't think that property is going to massively rebound. So that's what it is. China, a very slow recovery. Then I wanted to make a couple of comments on the market, very much related to what Alex was saying. If you see the performance of this year, if you look at the index, it looks a fantastic year. So the SPX is almost 20% up, the Standard & Poor's 500, and the Nasdaq is almost 40% up this year. So it looks like it's a fantastic year, but if you adjust this by the Magnificent Seven or the big capitalizations or the Big Seven, as some of the people call them, and then you compare what is the Standard & Poor's equally weighted with the index, you can see that basically the market, excluding the Big Seven, has been trading sideways, which is quite normal in the situation we are, kind of waiting for recession yes, recession no. So yeah, basically the market is not as good as we see in the index. In terms of valuation, the Standard & Poor's, excluding the Big Seven, is trading at 16 times, which is a bit below the historical level, which is 17, 18 times. And the P of the Big Seven is 30 times more, which is, this is very important because it exactly matches with what Alex was commenting. At a P of 30, growth has to be double digit. And you know, this big Magnificent or this Big Seven cannot really grow 10% for the long term because they are already too big. I mean, not Apple for sure, not Tesla for sure. There are many companies in this kind of Big Seven basket that cannot grow 10%. I'm talking about 10% forever. Just final comment here, we don't see a collapse in the tech space because the models are quite robust for this Big Seven. So we see, as Alex was saying, more a sideways move. Final comment on the market here, you can see that by December, normally we analyze all the geographies, all the indexes, also the sectorial indices. So this is a summary of what we find. And only looking at the P that you see in the second, in the third row, you can see the multiples. Value is trading at 12 times. Growth is trading at 25 times. So, you know, you see a big discrepancy here. So, you know, value needs to recover in the next few years. And then the cheapest sectors, as you can see here, are financials, insurers, energy, which is massively cheap. And also, surprisingly, staples and health that are, you know, trading at 17 times next year, which is well below the 20 times, which is an average. So these would be the sectors that, you know, only on a valuation perspective, they look attractive. We can comment that later. So Conclusion for this introduction, we're still in a slowdown. 3 out of the 5 leading indicators that we follow in this cycle are negative. So PMIs, manufacturing indices, still negative. Earnings downgrades still ongoing. Liquidity is still negative on rates and QT and taper quantum tapering. And then 2 are more or less stabilized or positive. China goes slowly, and the other one is rates and inflation. So conclusion, the slowdown not over. We remain basically on a scenario, and we are ready for, for both. Market will move up, we will do well. Market corrects, then we will buy more and rebalance the portfolios. So this would be my conclusion, and I think I hand over to Carlos now. He's going to speak about peak oil.
Okay, well, good morning. On the previous presentation we had and presentations we've had in Zurich and Geneva, and the newsletter that's coming out, I think, today or tomorrow, we discuss in a bit of detail this concept of peak oil. Now, peak oil has 2 sides of it. It has peak demand, and of course, now we have this COP28 conference going on where everybody is saying that, this is it. We have to get rid of fossil fuels. So peak demand, there won't be demand. But the original concept, and this is what we discussed in the previous conference call, peak demand, and we showed how, putting some reasonable numbers, there is no way in the world that demand for fossil fuels is not going to grow for a very long time. Eventually it'll disappear. I don't think in 500 years' time we'll keep using the same cars we use today, but certainly in the next 5, 10, 15, 20, 30 years, we will. That is one thing. But then, of course, the other side of the coin for an investor is not only demand. People obsess about demand. When you invent a new thing, start up, will people buy this? Well, that's obviously very important. If nobody wants to buy it, your product is worthless. But if everybody can produce it, your product is not going to be very profitable either. So supply, in fact, is what determines in the real world profitability of things more than demand, contrary to what people believe. Now, the original concept of peak oil was predicated of supply. That was an engineer, Mr. King Hubbard, who in the late 50s in Texas, in the US, well, he observed something that is obvious. If you start extracting oil from an oil field, well, eventually there is no more oil. That's pretty obvious. From any finite thing, you start extracting it and it runs over. But then he started trying to think, well, when do we know when that thing moves from increasing production at the beginning, then eventually it flattens out and then it starts going down? When is the peak? Now, he did a lot of some mathematical fancy formulas to come to a conclusion which sounds, not that complicated, but he kind of proved it mathematically. If you have a reservoir of, say, 1 billion barrels of oil, what he observed is that the cumulative production, once you have extracted half the oil that was there originally, then production starts going down. And that is a peak. Now, he, in the late 50s and early 60s, published the curve that you see in dotted line now on the screen, and everybody took it as something crazy, because at the time the US was by very far the largest oil producer in the world, with plenty of fields in everywhere, almost in the country. But he said, okay, well, this is what my numbers say. The US will peak production in the early 70s, and that will be it. And there's nothing you can do about it because there is no more oil left. There is oil left, but not enough to increase production. Nobody paid too much attention, but then what happened in the early 70s, as you can see in the solid line, is that production, after going up a bit higher than he had expected, started actually going down, pretty much at the exact time he had said. So the guy became immediately, immediately a hero, and then he died early. So, but everybody said, "Well, yeah, this guy was right," and everybody started talking. That was the time when the Club of Rome published the very influential book "Limits to Growth," early 70s. You know, limited resources, no more growth, Malthusian economics. This is it. Then a few years later, people found oil in Alaska and in the Gulf of Mexico, which Hubbard had not taken into account because technically those were not in the U.S. the way he looked at the U.S. So production went up, but as soon as production from those fields kind of got into the mix, then the curve started doing the same thing. So his theory or his model became again very influential. And then we got to the early 20s when oil started little by little become more and more scarce. We had years of very cheap oil, $10, $12 a barrel, and then started going up until it reached 148, I think, or 142 in June 2008. That is $200 in today's dollars, by the way, per barrel. And everybody had this model in front of them, and everybody thought, well, this is it. Now we run out of oil. So everybody started talking about peak oil, and that's when the thing became famous. Now, two things happened in 2008, as you know, of course. One is the biggest financial crisis in a very, very long time. And then is that a bunch of guys started working on a new technology to extract mostly gas, but eventually also oil, called shale. Now, shale oil or shale gas is oil and gas that was known to be there, but was never counted in this curve of Hubbard. It's not included because it was not economical to extract. For it to become economical, two things had to happen. A technological breakthrough, which was to mix two technologies that existed, which is lateral drilling and fracking, fracturing, exploding the rock inside to liberate the hydrocarbon. So one technological breakthrough. And then the most important thing, which actually prompted the technological breakthrough, is that price started going up. Obviously, nobody had considered that oil useful when oil was selling at 10, if the thing costs 40. But if the oil is selling at 140, well, then it becomes very interesting. So we saw what happened in the next slide is that on the left, you see what actually happened. Starting in 2013, 14, the whole thing took off. And now, of course, the peak oil curve became a lot of ridicule, if you wish. You say, wow, how wrong could you be, guy? This is a completely stupid idea. Now, the idea is not so stupid. In fact, we saw that when the Gulf of Mexico and Alaska were found, well, oil went up, but then it went down again. Now, depletion, the fact that fields deplete, that become empty, well, that is not a theory. That is just a very obvious, observable fact. In fact, I put you here, when we started working on oil, the second largest oil field in the world after Ghawar in Saudi Arabia was a field called Cantarell in Mexico. It was the second largest. It produced more oil than almost any other country in the world, just that field. And now look at the production of the field. It went from producing more than 2 million barrels per day to very little. And it is because it is empty. I mean, it is as simple as that, because it is empty. Now, that is not a problem just for the Mexicans in Cantarell. If you look at the next slide, you realize that this happens, in fact, in practically every single country. Right there you have Iran. Well, you could argue about some political things, but you have Algeria, you have Angola. These were big producers. Nigeria, Venezuela, and the United Kingdom. Remember, the North Sea is one of the things that saved the price of oil in the 80s. Well, it's over because these things are becoming empty. In fact, in the next slide, you can see that there is only Right now, 5, 6 countries in the world, well, 7, that are producing oil in any meaningful amounts, which is the US with the shale that we saw. You see the huge increase in shale there and the green line. Without that, oil would have been at $250 per barrel for a very long time now. Then you see Saudi Arabia and Russia still growing, but not that fast, and then the others. Now, what does that mean? What that means is that if we see the next slide, is there enough oil? Are we in peak oil, getting to peak oil? I mean, the amount of oil we can get in the next few years, 2, 3 years, is very simple. It's whatever we have today, plus whatever is coming, plus the spare capacity, minus depletion. Depletion happens every year. Whatever you do, every year you produce 5% less oil than the previous year, other things being equal. Now, the things are not equal. Oil companies keep reinvesting to keep producing the things, but if they didn't do anything, we would have 5% less every year. And eventually, the whole thing runs out. Now, so current production, we know what it is. It's about 100 million barrels per day, a little bit more, because that's demand. Spare capacity, we have 1, 2, 3 million, maybe, because with the recent cuts, it's not very clear. So that's enough for 1 year of growth, 2 years at most. Project pipeline is almost empty. People have not invested in oil since 2016. That's going to 10 years now, 7 years now. And 7 years is what a typical project takes to bring. So all the projects that started have already come. And there are no more projects. There are some, but very few projects. And depletion that keeps advancing. So short term, we cannot expect a lot more oil than we have. Now, we can go in the next slide. What shows in the next thing is that new discoveries are very far in between, and these people are not aware of, and this is very important. In the last 20 years, apart from shale oil, there have been basically two big, there have been many, but 2 big discoveries. The biggest one is what they call the pre-salt in Brazil, and then lately, 3 years ago in Guyana. Now, the amount of oil that's in those places, well, nobody knows until it's empty, because it's impossible to know, but it can be estimated. Now, in pre-salt Brazil is the biggest. It's probably between 50 and 100 billion barrels of oil. And in Guyana, it's between 10 and 15 towards 10, so maybe 11, 12. Well, that's a lot of oil, but you have to realize that every year we consume 36 billion. So the biggest, by far, discoveries we've done in 20 years are the equivalent to whatever, 3 years of consumption. So this is not going to work. So oil is not unlimited. So are we going to have enough oil? And the answer to that, go to the next slide, the amount of oil in the world, funnily enough, from a geological point of view, obviously it is a number. Nobody knows it, but God probably knows how many molecules of oil are there on planet Earth. That's a fact. But that's irrelevant, because you may not be able to access it. So it says, now, the amount of real oil that we can use depends on the technology that we use to extract it and the price. If we say oil has to sell at $5 per barrel, well, there is no more oil left in the world, because nobody can extract oil at $5 per barrel. If we say oil can be sold for $300 per barrel, then, as happened with shale or with the pre-salt in Brazil, oil that is considered uneconomical, well, becomes economical and then becomes oil. So, to summarize, we have enough oil maybe at current prices for the next few years. From then on, we do not have enough oil. The world has oil, but the price has to go much higher, so the world starts actually, conserving more oil and extracting more oil. Now, in the meantime, this is very inelastic. If people think that whatever, Russia invades Ukraine, the whole thing goes to the roof. Then if they do not invade Ukraine anymore and they go away, then the price crashes. All that is completely irrelevant. I mean, it's not irrelevant if you're an oil trader. You can become a billionaire or go bankrupt in 2 weeks. But for a medium long-term investor, that is completely irrelevant. These things fix themselves very, very quickly. I mean, oil in Russia, when Russia invaded Ukraine, went to 130. It's now 75, so over 80. So that disappears very quickly, and vice versa. The important thing is that to produce enough oil to absorb the demand that we saw in the previous conference call that is coming, we need to produce much more oil than it is currently being planned for, and that calls for a much higher price. Now, one thing that is added to that is that most of the calculations that have been made about renewables taking the place of oil, we're saying that they do not work. I mean, they never worked. I mean, they were wrong from the beginning, but now people are realizing it for two main reasons. One is that most of renewables do not substitute for oil, because oil is not produced mostly to generate electricity, but to move cars, and particularly trucks and trains and ships and planes, which cannot be moved with batteries, at least not for a very long time. And also because renewables are extremely expensive. You know, people keep repeating, as everybody knows, that solar and wind are the cheapest forms of energy, which is very nice, and they give you some numbers. And then you look at the world and realize that the countries like Germany, Spain, Denmark, New England, with the highest percentage of renewable energy, have the highest electricity costs in the world, which is kind of surprising. And it is because the way those numbers are calculated is completely wrong. It's the levelized cost of energy that Lazar Frères invented 15 years ago, and it is completely wrong methodology. And these things have an extremely low, and this is a very important concept, and hear it because you will hearing it very often from now on, is we are all familiar with return on invested capital, because we're capitalists. We put capital and we want to get capital out. If we're talking about energy and there is not enough energy, we have to get used to a new concept, which is energy return on energy invested. Now, how much energy it takes to produce energy? Now, if you can build a dam, a hydroelectric dam, in an easy place with an easy, you know, a valley such that with a relatively small wall, you get a lot of water in it, the energy return is enormous because you need very little energy to create the cement, the concrete to build the thing. And then that's it. And then you have energy forever. So that's about 80. It's been estimated. Nuclear plant is also close to 80, 70. The energy that you need, the energy that you get out of energy that you need to create to build a nuclear plant and exploit it, you get 70 times more energy. In some photoelectric projects, particularly in Germany, it's about 1.5. So you do not get any energy out of them. I mean, essentially zero, because you need a lot of energy. You know, one of the most energy intensive things in the world right now that mankind does is the polysilicon for the solar panels. And then if you put that in a place where there's no sun, like Germany, well, that's what you get. No energy out of it, no net energy out of it. I mean, it takes years and years and years just to recover the energy that you spent building the thing. Now, for solar and wind, return on energy return on energy is very low. And capital return is very low. All these projects were dreamed when energy was very cheap and when interest costs were zero. Now you put interest rates at 5 and energy at $80 per barrel, the oil, and they just do not make any sense, which is what we're seeing. So we're seeing then this move towards less emphasis, not rhetorically, everybody keeps talking about that, but in reality, we're seeing an increase in the demand for coal, record highs, natural gas, record highs, nuclear record highs, and then oil record high right now. So there's no peak oil in the sense that the world will not be able to produce any more oil tomorrow, but there is no oil at these prices in, let's say, 2, 3, 4 years' time. Okay, this is what I had to mention.
Thanks, Carlos. I'm going to go to the two funds and the investment case of this quarter. Let's start with the classic. So the classic had a kind of rough October and November. We are up 5% year to date. We were up 10% at the peak of the year, so we've lost 5 points from the peak. So a little bit below target, which, as you know, is 625 euros per share. But this is due to 3 negative news, very basically. Raytheon and MTU Aero Engines, they had problems with the GTF engine. Then salmon prices have been on the downtrend and some biological issues in the sector. And finally, First Quantum, the copper miner, is having problems in Panama with their mine, copper mine, Cobre Panama. So, you know, these 3 negative news have affected the fund, and we are buying. So slowly, patiently buying back the whole shares because we think that all these problems are kind of short-term. Even the problems of First Quantum in Panama, we think that they will be solved in the medium term. So this is why, you know, it's an opportunity for us, not really an issue. Year-to-date, best sectors, technology, cement, and financials. You can see the top picks this year, top performers, Pandora, then the 2 cement companies. And the worst sectors this year, salmon, as I was saying, salmon, aerospace, and mining. The worst stocks, Raytheon, Leroy, Bakkafrost, and ISS. So the message here is, when the fund underperforms a little bit, normally, if we are not wrong in our investments, we are buying back slowly and building up intrinsic value and IRR. In next slide, in the 23, you can see basically half of the book. So I like this slide because on a snapshot, you can see basically where we are invested. The 4Gs, again, I'm not going to repeat that, but all of them are good businesses, good management, good balance sheets, and cheap. It is true that some of them have issues, but our analysis suggests that there is a lot of money to make here. Just the brief comments on the 5 biggest positions on Grifols. Basically, we spoke to them yesterday, and everything is moving in the right direction. So good news, it's our biggest position. ISS, very good results in the last quarter, and the management is buying shares, which is also, you know, a positive indication. Pandora, I'm going to enter in detail now. Fantastic capital market day. So Exxon now is going to spin off Plaxi, which is the vouchers business, which is a kind of double-digit growth business. So we think we're going to make some money there. Finally, Unilever, new CEO, focused on execution. We'll see if this value stock can be kind of improved in the next few years. So you can see here that the fund is quite concentrated and diversified in the same time. In the next slide, you can see the updated IRR and NAV. So yeah, we've lost 5 points from the peak, which means that the fund is a bit cheaper. IRR is now close to 15%. The range, historically, you know, it's 12 to 17, so moving to cheapish part of it, and the intrinsic value is 920 euros per share. Just as an example, if we would have a big recession in the next 2 years and the market would correct, as always, as usual, the fund could go as low as 425, which would be the level where we would kind of move full in the fund, which is more or less 30% below the current level. This can happen anytime because, you know, the fund is long only, we are not hedged. At this level, we would do 3 things. We invest the cash, as we commented already. We balance the portfolio, which is a very powerful tool, moving from categories 1, 2 to 3 and 4. And also we would add some new names that are already in our watch list. We did that in 2020, so we experimented this on a hard way in 2020, and the fund has multiplied by 2.5 times in 3 years, which means that any big correction has to be seen as an opportunity. Just as joking here a little bit, we have soft indicators here because, you know, over the years, we've met investors, friends, even family members that normally they withdraw the money at the bottom of the market, helping us to identify the low point. So that's kind of a bit of a joke. And basically, we would use them to match our vision that the market is at low levels. Regarding the net asset value and the expectations, I've improved a little bit the chart here. So this is a 10% per year performance for the fund, just a 10% extrapolated to the next 7 years. So this is the path that we should be able to follow, sorry. So this year we are in 595, a little bit below the 625. And I want to keep this 1,000 euros per share for 2028. So, you know, this chart shows the powerful combination of long-term and compounded returns. So 10% return is doubling every 7 years. We've done that for the last 10, 12 years, and we think we can do it in the future. The more correction, the better we do. Regarding valuation, you can see in a snapshot here, the PE of the fund, 11.5 times 2024, which compares 15.5 with the MSCI World, 10 times 25, dividend yield 1 point more, and price to book well below the average of the market. So we are buying quality at a discount, and this is also a protection for our performance. So let's go to the investment case of the quarter, Pandora. They did a capital market day in October, and we were really perplexed because, you know, in the front of a slowdown, they go out and say that they're going to grow 8% organic growth in the next 3 years, and they're going to improve margins up to 26-27% EBIT on sales. So, you know, this is well ahead of our estimates and well ahead of consensus. And it translates with an EPS growth of 15 to 20% in the next 3 years, 20% free cash flow yield in the next 3 years. So very good perspective from the management. And if you use this number to take a past valuation, you can easily go to 1,400 kronas, which is an upside of more than 50%. Only looking at the PE 2025 in red in the table here, you see that it's trading at 11 times, which is very cheap for a EPS growth of 15 to 20%. And in the next slide, in page 28, you can see the most important part of the investment case here, which is the qualitative assessment, top-class management. They have a CEO who is really outstanding. Brand, you know, they have a brand, very well recognized and investing behind it. The network of stock has been renovated, the same with the training of employees, so they are really building an experience there. The Moments collection and the bracelets and charms are the core of the company, and the company is not willing to, you know, to leave them, because even if they are a big chunk of the business, they think there is a lot of upside and they're investing behind them. And they're launching new collections in order to diversify. So I would highlight Diamonds by Pandora, which is lab-grown diamonds that, in our opinion, can be really a game changer here. Digitalization strategy, they're selling 20% of the sales now through digital, which is amazing. A few years ago, they were selling zero. New IT system, new ERP system, and a healthy balance sheet. So now the company is really top in terms of operations, and they have completely, I mean, this guy, the CEO, has changed the company in 3-4 years. So, you know, congratulations to Pandora, and we still own the company. That's for the investment case. Moving to the Natural Resources Fund. So here we also had a tough couple of months. The fund was up 13% by the end of September. Now it's up only 3%, 142 euros per share. Best sector year-to-date, infrastructures, double-digit growth, so performance, led by cement. Good performance of mining, more or less, up 2%, and the disappointing sectors have been oil and energy and agri-food, which are down on the year. You can see here the best name, CNQ Petrobras, Kazatomprom, Southern Copper, Cameco, all more than 20%. On the negative side, basically it's energy and salmon. So yeah, the thing is, the summary is, the sector is fighting with a recession fear. You know very well that commodities are quite volatile and very much exposed to macro. So it's quite normal that the fund and the sector doesn't really outperform massively in this uncertain environment. In page 32, so we updated the exposure. So the big changes here, oil more or less remains 1/3, gas, it's a small 4%, copper 25%, but this has not changed. Big changes in cement, where we sold a little bit, now 5% used to be 10, while we are investing in salmon in a big chunk, so salmon is 16% now and buying more. Uranium also we lowered a little bit because Cameco more than doubled in the past few years, and the rest more or less remains in the same position. So this is to show you that we have more or less the levers to move within the different subsectors, because this year energy and mining are negative. The sector, the MSCI mining, MSCI energy are down like 4% year to date, and we are kind of able to offset this, and the fund is up 3%. In slide 33, you can see the updated intrinsic value on IRR. As the fund is down, basically from up 13 to up 3, it's down 10%. The IRR is up 10%. So the IRR, roughly, it's 15.7, so approaching 16%. Very interesting return. And don't forget that we always use mid-cycle estimates. So we are not valuing these names at the top or peak earnings. So the current valuation is very cheap, and it's very normal. As I was commenting, we are now in an uncertain economic scenario, so the sector normally trades at a discount. But in the end, you know, I'm very much aligned with what Carlos was saying. We are here for the long term, and what we see is an issue in the supply, not in the demand. We don't really care what happens this year or next year. Long term, we see issues in oil, in copper, in uranium, in salmon, in cement, among other commodities. So we will be playing this for the long term. On our numbers, we should be able to double on this IRR, to double the value of the fund in the next 5 to 6 years, a bit better than the classic, if I may say. And this is a little older slide because this data is from June, but if you reduce the multiples by 10%, which is the fund has fallen more or less 10% from peak levels, you can see that the PE for 24 would be around 9, dividend yield around 4, and price to book around 1.3, 1.4. So very, very attractive multiples in order to, you know, give you some hints on the cheapness of the fund. I'm going to comment a little bit on oil and copper, which are our biggest positions, and, you know, trying to give some color on the short term. We like the long term, but I'm going to give a little bit the view on the short term. This is our estimates on demand for oil in the next 2 years. So 2023, 102 million barrels a day demand, and in 2025, 104.5, so 2.5 more or less. And the supply, we see the supply more or less aligned with demand. So in the next 2 years, we see more or less the market balanced. Why? Because the economy is not super, you know, growing a lot. And secondly, because OPEC Plus has cut a little bit, and we need them in order to rebalance the market. So the more important idea here is what Carlos was mentioning. Shale brought 10 million barrels a day in the last 10 years, so 10% of the supply. And if you look to 2030, we will need another 8 million, and there's no another shale. So, you know, CapEx needs to rise a lot to incentivize new projects. And the problem is very structural because we have 2 issues. One is fear of peak demand. A lot of people are convinced that demand is starting to fall, and then they don't want to touch oil, which is wrong. And the second is ESG, because, you know, oil is, you know, related to pollution and CO2. And then it's a big issue in order to fund new projects. And in order to give you a little bit of granularity, this is the new supply coming for the next 2 years, 24 and 25. And in the red, I have put what Russia, Saudi Arabia, and other OPEC needs to bring back in terms of production in order to balance the market. So excluding OPEC Plus, we would be in deficit of around 500,000 per year, barrels a day. But these guys will bring back the spare capacity. And spare capacity is difficult, but, you know, roughly speaking, OPEC has maybe 3 million, you are optimistic. So, yeah, everything has to go really, really well to offset depletion, to offset the replenishing of strategic reserves, because now the US needs to refill its reserves. This is 500,000, and this is not including my estimates. So, you know, everything has to be very, very good in order to more or less balance the market in the next 2 years. After that, we're going to see a big problem because we need another shale oil. And final comment, if I may, in the slide 37, it's copper. So you see in the chart what is basically the consensus and our estimates. We have enough projects for the next 2 years. Actually, it's surprising to see it's very much aligned with the reading in oil. So we have more or less projects for the next 2 years, but there's not enough projects up from 2025. And then you see how the market goes to a deficit. Not only this, problem here is that demand is going to extend to start increasing more. Historically, in the past decade, copper was growing by 500,000 tons per year, and now this 500,000 will move to 1 million because of the electrification. And again, huge constraints here to new mines like nationalism, look at Panama, taxes, and ESG. So really, the copper market looks you know, very, very good for the long term. Even in 2024, we had a big profit warning from Anglo American 2 days ago, and these guys reduced the production for the next 2 years, around 200,000 to 300,000 tons per year, which is basically the supply you see here in the chart. So only if I adjust these numbers by the profit warning of Anglo, then we go to kind of a deficit of well in 24 and 25, proving how difficult to extract copper is. Conclusion, short term, we will keep fighting against the recession fear, so nothing to worry about. All we will do is patiently buying back at the right levels and then rebalancing the portfolio. Longer term, nothing has changed, as we were commenting, Carlos and myself. You know, oil, the problem is basically capex that is not there. And on green metals, it's both sides. There's no capex, and there's demand is going to start growing a lot. Valuation is good. As we said, with the correction this year, we are well below mid-cycle, so fantastic. And basically, you know, reiterate here that the cycle this time looks a very long cycle due to the energy transition. So if the commodity cycle is normally a long one because you need to bring supply, it takes 5 to 10 years. Now, you know, with the transition and the electrification, we are talking about decades of high demand growth. So it's going to take more time. So we remain very bullish on the sector. And I think I will exactly hand over to Urs on his natural resources thoughts.
Thanks, Marcus. So I thought I will explain a few shorter term things and why we have some short term cycles in commodities. So we have in the last few years often explained the structural things, but if you look back in a bull market, it never goes up in a straight line. And here, you know, I want to have an example in the case of lithium, why we have such extreme moves. You see, they multiplied by 6, and now the price has been divided by 6. And you know, always when you hear these strange demand stories, which in the case of this lithium is one of the most ridiculous thing I've ever heard in my life, that everybody buys Tesla. But what's happening, you know, you have a little bit of shortage of lithium because you have this situation. Then everybody starts up building inventories. You know, the Teslas of these worlds are securing lithium supply. And then you have financial speculation coming in. When we were touring around in the last few years, everybody had a lithium exposure. I mean, it's a ridiculously small commodities, but due to this story, they build up lithium, the price goes up more and more. And then, you know, you have projects which are having different cost levels. All of them become economic on paper. And then everything gets funded. And now you have the situation that a lot of lithium comes to the market. And this first boom, for example, in these electric vehicles is flattening out. And I'm a bit cautious if it will continue as people expect. And then you have a huge oversupply of lithium. Nobody needs it anymore. And then it divides by 6. I mean, this is quite a lot. And on the right-hand side, you see a similar story, which you might remember 2 years earlier, is the price of cobalt. Exactly something similar. And what I want to advise, hold on a second, that in such a situation, people, and what we do in the fund, you always should focus on the best asset. On the next slide, Oleg, You see the chart of Albemarle, which is a company which is having the best mine in the world. It's Greenbushes in Australia, provides around 30% of all the lithium. And if you want to sit out now this situation, which will take 2-3 years, you have immediately moving to the best asset, because the other ones will disappear, because to procure for high prices are high prices, and this supply has to exit again. That means that most of the mines which have been funded will not come into production or will disappear, and it will be good in 2-3 years for the ones who are surviving it. But I think you should be careful in such projects and move to the best asset, which would be in lithium Albemarle. On the next slide, Alex, you see something which is also happening. That's one of the best projects in the world. It's Liontown in Australia, which Albemarle wanted to buy a blocking stake, and now it got bought by Gina Reinhardt, which, by the way, makes the money with iron ore. She gets a royalty from all the exports, which is more than 50% of the continent. And she bought now a blocking stake in this project, but she won't give you a present really, because she will wait until everybody is dying out, and then she will be taking over this project for full, not now, but maybe in 3 years when the stock price is down 80%, but at least you might get something. So I'll come to that later. In lithium, Albemarle, a company we used to own, now trades on 10 times earnings, but probably rather on 20, because the earnings will go down further. And maybe in 2-3 years, this is the one who survives. It will definitely survive, and it's something to consider again as an investment. Now I come to the next situation, uranium. Now I won't go into detail on the structural situation. It's completely different to lithium, because it has a structural undersupply, because a third came from above stockpiles of nuclear warheads, which disappeared. But still, you know, Comico, which is a position we own and we are reducing, it multiplied by 6. The same chart is the uranium price. It was at the bottom at 18. Now it's over 80. And at 18, you know, the cure for low prices are low prices. It was a free lunch, because of a lot of supply disappeared. The best mine in the world is McArthur River with 15% grade. And even this mine has cash costs of below 30. And Comico said we close the mine and spare the resources and reserves and buy in the spot market instead, to deliver into our contracts. Obviously, if you can buy at 18, instead producing as 27 to deliver into contracts, you rather do that. It means obviously the market is drying out at the spot supply. So this is the reason why it multiplied by 6. On the next slide, Alex, you see the valuation. I mean, it has now really a PE of 30. Maybe it's a bit less because uranium price might go up further, but I mean, it's not really value in mining and so. So, you know, we get some things at the PE of 1. And on the next slide, Alex, something similar, what we have seen, for example, in copper 2 years ago, you know, the cure for high prices are high prices. Now at 80, the easy wall of supply, which has been taken away and been on care and maintenance, comes back. So just 50% of the mine supplies Kazakhstan and Comico, or at the Bascan basis. So Kazakhstan brings back now 12 million pounds till 25. MacArthur River brings 18 million pounds. Paladin brings back Lange Heinrich in Namibia. It's another 6 million pounds. So these 3 mines alone, or 3 companies alone, bring 36 million pounds. A market which has around 200 million consumption and around 130 million pounds market supply of mining. So it's a third of the mine production which is brought back. So usually this is a situation which always what I want to explain in commodities. You know, we always with high prices, you have a bit additional supply, vice versa. So I think uranium is a very good commodity and everything is fine, but I think it's not tactically a good moment to enter this market, because you have probably a bit of supply. And also if you look at this hype which has been around of this Sprott and also this yellow cake ETFs, there's been quite some inventory which has been absorbed and built by speculative activity. So we rather point to the fact it should be a bit reduced at the moment. Doesn't mean one had to get out completely. Now the next chart is copper. I mean, it's the same again, 2 years ago, we had a multiplier of 3 times in copper. Everybody was crying, Tesla needs so much copper and all these stories. We do tell them as well. They are good stories. But after a multiplier of 3 in price, you have some mine production coming back, the easy wall of supply comes, some speculative inventories, etc., etc. And now as we have seen in the previous slide, since 2 years, we are on a consolidation and in an economic slowdown. And this is why the copper price has now consolidated for 2 years. Everybody is bearish. On the next slide, Alex, we see the speculative exposure on the COMEX. Because you see, if you're anticipating the recession, etc., you're shorting copper, you're selling the cyclical companies, etc. This is why we have one of the most extreme negative positioning now from financial speculators, which were, as you have seen on the chart before, very long and very bullish at the peak. And now it's the opposite, which is usually a good sign. And on the next slide, Alex, I just have some headline. You might remember my comments I did during the last month. So I often showed the global liquidity of central banks in M2. And I always wanted to point out that if you look only at the Fed and the ECB, this is not the world. And the global liquidity is not as bad as it seems, because it had hit the bottom already in the autumn 22. And since then, we are quite liquid from central bank, not Western world, but emerging markets, particularly China, but many others. And here it's now the outcome. India expects a GDP growth of 7% next year. And this is the comment from Rio Tinto on the steel market. It's running flat out. It's driving, the steel market is really producing as much as it can, and it's being absorbed in China. Housing is not good, but infrastructure, automotives are booming. And iron ore price is soon going to hit 140. So I always wanted to point out that this global economy is not as bad, and nor is the global liquidity. And I would be a bit careful to be too negative on these things just because of the situation in the Western world, interest rate wise. And 7% GDP growth is not that bad, no, I would say. And India is actually the most populated country in the world. So it's not an unimportant country. So on the next slide, that's just a few charts of some base metal companies. You see all the same. First Quantum down a lot. On the right-hand top side, Glencore a bit. And here on the next slide, Alex, just the figures from a company like Glencore. Of course, when commodity prices correct, you have EBITDA, which come from a peak from 36 billion to 18. And of course, there is a correction, but these companies are still making a lot of money and prices are still very good. And I think this is a good situation to go back more into the cyclical part of our portfolio. Base metals or met coal or iron ore, all these things, people are negative because of the industrial slowdown, which we have seen for 2 years already. And I've shown the charts of iron ore inventories at Chinese ports as a proxy. We have had a reduction of inventories for 2 years. On the next slide, Alex, this is, I think, it's now a good moment to go back into the base metals or more cyclical things, because you have run down inventories. Financial speculators are very negative. The economy has seen the low worldwide long time ago, as I have just shown. And now you have always the situation that also for mining, the effects on the price are beginning coming at the beginning. The copper price rose, and then you have the negative effect of the inflation on the cost side being delayed, and then the margins are shrinking because the commodity price is correct and the costs are going up. But now, if you look at this situation, just a few headlines. Marcos mentioned it. Anglo, cut the investments, cut production. They say not everything is profitable anymore. You have now the cure for high prices again. A lot of production goes away because the marginal production is already not economic anymore. And this is exactly the opposite short term what we see in uranium, that these base metals, which have been correcting 2 years, is now are going to see a reduction again in supply, which is, in our opinion, very optimistic. And maybe just to show on the next slide, Alex, a statement from Don Corleone. It's not personal, it's purely business. So you find value always where nobody wants to go. And this is an example of Glencore, which in my opinion are not the most stupid people in this business. What they're not buying uranium now at 30 times earnings, but they go now, for example, and buy met coal, which is going to the steel market. Teck sells its met coal business. There are only two major met coal, seaborne met coal suppliers. It's BHP and Teck, which is now being bought by Glencore. People are bearish on it, first because of coal and the whole issues with it, and secondly because of the economy, because of the steel market. Everybody's bearish, but I have shown steel market is doing well. And this asset changes hand, you know, for 8.9 billion, and it's an estimated EBITDA of nearly 4 billion next year, and it comes debt-free. So they're paying 2.3 times EBITDA. So that's less than 20 times. It's, you know, so looks cheap. And when met coal prices were high, this asset made 6.5 billion. So, you know, that's a company like we have in our fund, like Glencore, buying a cheap asset, which they do see rather in the cycle part of our portfolio. And on the last slide, Alex, another example, you know, we have two positions in North Sea oil, which is very cheap, which is Aker and Harbour. And I think they trade below 1 times EBITDA next year. And this is an example of another company of Tullow Oil, which we don't have in the fund. It's very small, and it has a debt issue maybe, but trades on the same 0.5 times EBITDA estimated next year. And here again, Glencore seems to see some value in North Sea oil as well, as they do a debt financing of nearly $500 million. And they get 15% interest. And I know how they're thinking, you know, either they make a good investment and have 15% interest, or they get the assets in the North Sea, which wouldn't be probably that bad if you get them at 0.5 times EBITDA, 0.5 times. So that's maybe to show that not only us, but also some other people in the industry, which probably have more knowledge or other knowledge or better knowledge or more or less intelligent, who knows, but at least a company like Glencore seems to see value in similar places as we do. That was my remark, Alex. Thanks.
Thanks a lot, Urs, for your very detailed presentation. With that, actually, we are at the final remarks from my side. We are already passing the 1 hour time. We have received the questions for you, Marcos, which is, can you explain us on the debt situation of Grifols? Apparently, it's increased this year.
Yes. Grifols. Well, we spoke to the company yesterday. They confirm what they are doing. They're going to sell part or the entire Chinese business. I think it's going to be part of it. And they're going to get a couple of billion, maybe 1.5, maybe 2 billion out of this sale, reducing the net debt from 9 to 7. And then they are having like a cost-cutting plan of 450 million euros, which is going to be helpful to generate cash flow. So basically, you know, the business is back to normal following the COVID kind of downturn. So on our numbers, in 2 years, the company should be able to be back to normal around 2 to 3 times debt to EBITDA, which is very safe for this type of business. So it is true that it's not kind of initially a good investment because the level of debt is very high, but everything suggests, due to the quality of the business, that they will be able to be back to normal in a couple of years. And this should be very positive for the stock price.
Thanks a lot, Marcos. Please let us know if there will be any other questions. I mean, we are here. You see our contact details, the email addresses, the phone numbers. We will be also happy to join you for a meeting, whatever your requests are. With that, we would like to close it, and we wish you all Merry Christmas, happy end of the year, and then a great 2024. Thanks a lot, and take care, and hopefully we get not only rain, but also some nice snow for the mountains. Thanks a lot. Bye-bye.